Good evening, everybody.
Good evening, Jatin. Good evening,
Good
everyone.
evening. How are you, Manisha जी?
I'm very good. How are you?
बढ़िया. आपका तो एक के ऊपर एक आ ही रहा है. सबको क्लीन बोल कर रहे हैं आप शायद राइटिंग में.
नहीं नहीं, बस हम अंदर से साफ होते जा रहे हैं ना.
ऐसा
आई एम
क्या?
ग्रोइंग.
आपका एक हमको हमारे क्लब के लिए रखना पड़ेगा.
बिल्कुल
ऐसा लग
रखिए.
रहा
आई एम
है.
ऑलवेज देयर. या ऑलवेज.
सजेशन.
यस, डेफिनेटली. थैंक यू.
फिजिकल स्टार्ट हो जाएगा तब तो, मगर आप आना चाहिए ना पहले. लेटर आई विल कॉल यू. डोंट वरी, आई विल कॉल यू एंड विल कोऑर्डिनेट. ओके.
Hi Jatin.
Okay.
Hi everyone.
Hi Ravi, how are you?
Good, good. How are you? How is everyone?
Fine, fine, good, good.
Bhaji,
बरोबर चल रहा है.
Lata Ben.
चलो. Good to see you in RC BMW t-shirt.
Yes. Hi Kedar.
People are joining in.
Hello, sir. How are you?
We have
Good.
we have 3-4 minutes to go to start the meeting officially.
Hi CM. Hi Utpal.
Everybody is on mute, so if somebody wants to just interact for couple of minutes, just unmute yourself and talk.
Yeah,
Dr.
fine.
Utpal,
Thank you.
good
Good evening, everybody.
Mistri Sahib, good evening.
Good
Good
evening.
evening, CM.
Good
Yeah, hi,
evening,
CM.
Manisha. Good evening.
Good evening.
Hi,
Hello,
Utpal.
Manisha. How are you, Manisha?
I'm very good, Jayashri Ben. So nice to see everybody actually after so long.
Yeah.
Yeah, so since members are joining in, I'm just trying to, keep everybody engaged. We
Yeah.
are planning, since Corona is now subsiding, we are planning picnic to Tansa Farm.
Oh, that's lovely.
Okay,
That's
so
lovely.
it will be on 13th of February. 13th of February.
13th February.
To Tansa. Would some dance by the school children from Uchat, some traditional welcome, and then we plan to have some typical Maharashtrian food in Tansa. And we want everybody to be free by 1:32 so that they can drive back home. We will activity, some games or some activity to engage everybody. Small, as soon as everybody arrives, there is a plan to take everybody on a half an hour or 40-minute walk on the farm. Let us see how things go in the next 1 week. We will keep you posted in 1 or 2 days about the plan. I hope everybody is excited for our upcoming picnic after a long time break of 2 months.
Good evening, everybody.
Hello.
Good evening, Mihir.
Am I audible? બધાને સંભળાય છે મારો અવાજ,
Yes,
સાહેબ?
yes. Good evening, Mahir.
Good evening, everybody.
Hi Mir.
As Jatin was telling, આપણે 13 તારીખ ફેબ્રુઆરીએ we are planning a day picnic to Tansa. Basically, morning 9:30 will be reach. We all have to reach Tansa. And post lunch, આપણે બધા નીકળી જઈશું. We have organized a very good day outing. બધાને આવવાનું. It is a request to બધા આવજો, બહુ જ મજા આવશે. આખું ડિફરન્ટ ટાઈપનું એક આપણે પ્લાન કરી રહ્યા છે on 13th February. It is a Sunday basically. એટલે બધા Okay, Kedar, where are you, Kedar?
Yes, Mir bhai.
Can you take over now, please? એક મિનિટ, અચ્છા 5 મિનિટ. જતીનભાઈ ની કઈ યલો સફાઈ ક્લબમાં વાત ચાલુ છે.
Yeah,
Let's
maybe
go 3 minutes more, Kedar.
chalse, sure. We can wait for 5 minutes. Then my team is here, so whenever you give us a go ahead,
Yes.
we'll start.
Done, done. Just give us 2 minutes. We'll get back to you.
Sweet.
ચાલુ જ છે.
Okay.
I hope everybody has received the dinner. બધાના ઘરે જમવાનું આવી ગયું?
Okay, good.
Good,
Okay,
sure.
so I welcome everybody today on this Zoom meeting. I would just like to inform you that today's meeting is a joint meeting for our presidents of all the Rotary clubs of District 3141. There have been different groups. So I belong to the Yellow Sapphire group, and the Yellow Sapphire group consists of about 10 presidents. So this is today's event is a Yellow Sapphire event. So now I am calling this meeting to order. I request Jaishriben, it's a surprise for you. If you can unmute yourself, can you start the national anthem, please? If everybody can raise their hand, or if anybody wishes to stand up, kindly raise your hand and sing the national anthem.
જયશ્રીબેન તમે
Thank
સ્ટાર્ટ
you.
કરો પ્લીઝ.
Yeah.
I think Jaishriben is on mute. I
જયશ્રીબેન
think
મ્યુટ
Jaishriben
કરજો
is on
તમે.
mute. She said,
Okay, okay.
okay, okay. Yeah,
Okay,
please.
start.
Thank you.
जनगणमनाधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना उज्जल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाये तव जय गाथा जनगणमनायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय जय हिंद.
Jai Hind. Jai Hind. Thank you, Jaishriben.
Yeah,
So
thank
as
you,
I told
Jatin bhai.
you, thank you, Jaishriben. As I told you, today's meeting is a Yellow Sapphire event, and I would like to welcome my Yellow Sapphire district team members first. So I start with, we cannot hear them, but they are on YouTube. So I would like to welcome District Secretary Rajan Agarwal ji. Then I would like to welcome our Assistant Governor Deepak Goenka, also District Trainer Deepak Chaudhary. This is the core team for my group, and also I am happy to announce that today we have 5 Yellow Sapphire clubs as our co-host. So I welcome Rotary Club of Mumbai Juhu President Ashish Patankar and his members as co-host. Rotary Club of Mumbai Coastline President Abhay Bhatia as co-host. Rotary Club of Mumbai Goregaon West President Uday Desai. Rotary Club of Mumbai Warsaw President Lalit Mutreja. Rotary Club of Mumbai Mahakali Caves Gurdeep Bhamra. Rotary Club of Mumbai Royals President Deepak Gupta. Rotary Club of Mumbai Andheri Agarwal, President Sushil Agarwal, and all their members in this Yellow Sapphire event. Thank you everybody for attending today's event. Today's event is, a very sensitive subject in a way, It's a discussion on how to protect your wealth for your loved ones. And it's a very interesting subject. The key speakers are from the Anand Rathi team. The key speaker is Chintan Shah and Sanober Marolia. And the moderator for this event is Rotarian Kedar Bhatt from our own club, Rotary Club of Bombay Northwest. So I request from here on Anand Rathi team and Kedar Bhatt, Rotarian Kedar Bhatt, to please take over and take us through this journey of how to protect your wealth for your loved ones. Thank you so much for being here. And Kedar, kindly take over, please.
Thank you, Jatin sir.
Yeah, Rayan, carry on. Yeah.
I'll take over from here. Good evening, dear Rotarians. On behalf of the Anand Rathi Well team, I, Rehan Darbari, welcome all of you to our today's event, How to Protect Your Wealth for Your Loved Ones. The moderator for today's event is Mr. Kedar Bhatt. Let me give a brief introduction about Mr. Kedar Bhatt. Rotarian Kedar Bhatt works in the capacity of an Associate Director at Anand Rathi Wealth Limited. Being part of the organization since 2007, Kedar has been instrumental in the transition of the company's evolving approach to wealth management. He and his support team currently manages assets worth nearly $500 million across 300 global families. Kedar is a Rotarian from the Rotary Club of Bombay Northwest and started believing in the virtue of community service at an early age of 12. Both his parents have been members of the Rotary Club of Bombay Northwest since 1994 and past presidents of their club. Welcome, Mr. Kedar Bhatt. The key speakers for today's event are Ms. Sanober Marolia and Mr. Chintak Shah. Let me give a brief background for Ms. Sanober now. Ms. Sanober Marolia heads the asset planning team at Anand Rathi Wealth Limited. She is a law graduate and has over 15 years of work experience in the industry. She and her team helps create safety nets and transmission of intergenerational wealth. In the last 8 years, the asset planning team has made over 600 private family trusts and drafted and registered over 3,500 wills. She works alongside 6 team members to offer holistic solutions, keeping the legal, financial, and taxation aspects to designing customized estate planning for clients. As a structural architect of the organization's asset planning division, Sanober provides in-depth knowledge about the succession laws and a comprehensive understanding of family dynamics. Now, let me take a minute to just introduce Mr. Chintak Shah. Chintak Shah, as the head of the taxation, joined Anand Rathi Wealth in 2015 and has an experience of over 10 years in taxation. He and his team manages the entire gamut of taxes for all the Anand Rathi Wealth clients. He and his team manages the entire gamut of all the Anand Rathi Wealth clients. He is known for identifying tax efficiency in investments and providing tax planning options to our clients. Chintak works alongside the asset planning team in advising and design customized safety net mechanisms for the clients. He also provides technical insights based on the family dynamics and regulatory requirements and helps the clients with trust formation. By qualification, Chintak is a chartered accountant and a chartered financial analyst. That was the introduction of Ms. Sanober and Mr. Chintak. Kedar, over to you.
Thank you, Rehan.
So, yes, good evening, everyone. Thank you, Jatin bhai, Mir bhai, Sandeep bhai, Manish bhai, for giving us an opportunity. Today, like Jatin bhai has already highlighted, yes, during our journey of managing wealth for our clients, we realized that there were certain sensitive topics to Indian families. And maybe we were possibly in the position to do justice when it came to these subjects, because we, being as an outside advisor, we could really break ice with families and discuss matters which possibly were very sensitive for them to internally take up. So the title says how to protect your wealth for loved ones. Now, generally, when you take this title, there are 3 portions to how do you protect your wealth for the loved ones. So the first one goes is that the way you will grow your wealth, it has to basically beat inflation over longer periods of time. Because what we've realized in India is that the wealth is intergenerational. We don't follow family patterns like US or Europe, where possibly an individual would blow up their wealth in their lifetime. There would be certain amount of their wealth, assets, properties, which will get transferred to the next generation. And we've seen this habit across families that we manage. So what we realized is that if the monies are going to actually get transferred to the next generation, the most important part is to hold the purchasing power of the corpus that you created. And how do you hold the purchasing power of the corpus? That you constantly beat inflation, not the inflation numbers that the government releases. Thankfully, we are from the fortunate lot where actually the government related inflation, which is also calculated in a very different pattern, does not apply to our families. So our families, we spend on various things like foreign education, foreign travel, spending more on health infrastructure. All of these components, they follow a very different style of inflation. And if I were to look at last 30 years, the inflation number is somewhere in the range of 9%, 9 to 10%. So unless and until my post-tax wealth is not generating these kind of returns, I am actually not growing in terms of when I transfer my wealth, the purchasing power will be lost. The second broader objective to this of protecting wealth is how do you really try and save your money on taxes? Because it's so through the legitimate way, of course, there are methods, mechanisms where Chintak will take us a little more in detail today of how do you try and actually improve efficiencies on the taxation side. So when you are really going to transfer wealth to the next generation, it will be the post-tax money, and how the post-tax money will be really something which should be substantial and should not really lose out money in the process. So the second part of this is taxation. The third is estate and transmission. So estate planning and transmission, when I talk about, is a subject which Sanobar will cover, of how do you really create ring fence around your personal assets and how that can be transferred in a smooth way. Most of us know ways which are only possibly a will, but there are other mechanisms of how this transmission can happen. So Sanobar will highlight aspects of estate planning and also synchronized wills and nominations. What we've done today is we've tried kind of covering only limited areas because of the paucity of time. So we have carved out some specific ideas and deals where Chintak and Sanobar can highlight and which every investor should be knowing. So Chintak, over to you. You can start with the taxation bit and then Sanobar can continue from there.
Thank you, Kedar.
Yeah.
So yes, hi, good evening, everyone. What we'll be doing, we've carved out certain slides which I think every investor should know when it comes to, tax planning, right? These are basic, fundas which are, available on the internet, but the application is such that, may not be available, right? So today the flow is going to be, we'll discuss the idea and we'll see the application or the potential application of those ideas, right? With that context, I'll just start, sharing my screen. Just give me a moment. Yeah, is the screen visible, Sanova? It's full screen, right?
It is.
Yes, Chintak.
Okay, thank you. Right, so I think, what I feel is after our interaction with various clients, right? I've been in the organization for about 7 years now. And I realized that there are certain things that, it is very, very important for an investor or for a client to know. What I've done is I've tried to, put it in a presentation form and, I will take you through that. So the first thing that, a person should know is the set off and carry forward of losses provision, right? So Income Tax Act, allows for loss, which is generated from a particular head of income to be adjusted against the other head of income, right? Maybe just to give you a backdrop, there are 5 heads of income under the Income Tax Act. We have income from salary, which is our employment income. We have income from house property, which is the rental income. We have the business and profession income, which is the 3rd head. 4th head is capital gains. And the 5th head is income from other source. Now, while the losses can definitely be adjusted against the same head, meaning if let's say I have a equity loss, and at the same time if I have an equity gain, they both form part of the same head and therefore can be adjusted against each other. But the question is, can maybe a business loss be adjusted against equity income? That is what we've tried to cover with this particular chart. So on the left-hand side, we have all the losses, which is, if I have a loss from house property, or if I have a business loss, if I have a capital loss, and on the right-hand side, I have the incomes. So wherever we see a tick, it means that it can be adjusted. So loss from house property can be adjusted against all the other heads of income, right? So we see a tick. However, there's a caveat that the adjustment can only be done up to rupees 2 lakhs. Therefore, not very, very relevant from an HNI point of view, right? Now, business loss can be adjusted against all the other heads of income except for salary, right? So let's say if I have, my business unfortunately faced a loss of, let's say, 10 lakh rupees. But in the same financial year, if I also have a capital gain, from, let's say, real estate sale, then business loss and, long-term capital gains from real estate, can they be adjusted? Again, answer is yes, right? Because we have a tick here. Then comes the possibility of a long-term capital loss. It can only be adjusted against long-term capital gains. If I have a short-term capital loss, it can be adjusted against long-term as well as short-term capital gains. Right? Loss from other source is more of a theoretical head in nature, so I won't focus on that too much. So the section in itself is quite, simple, right? But how do I, benefit from this particular section? What I can do is I can give you a couple of examples, right? Of how, we've been able to utilize this. One, I think, prime example that comes to my mind is, in March 2020, what had happened is that, markets were down drastically. Markets had, come down to 8,000, 7,500 levels. At that point in time, all the portfolios that we were managing, as far as equity side is concerned, were in negative, right? Naturally, what we thought of is, let's capitalize on these losses, right? How do I benefit out of these losses? So what we did, we moved, mutual funds that our clients were holding from a growth plan to dividend plan. Now, why did we move it from growth to dividend? We did not want that the client should actually exit the investment at a loss. We just wanted the tax loss from it. So by switching it from growth to dividend, I was able to realize a tax loss. Right? To give an example, let's say I bought a mutual fund for 100. Now the value has temporarily come down to 60. When the price was 60, I moved from a growth plan to a dividend plan, which income tax recognizes as a transfer. And therefore I was able to, book 40 rupees of losses. These 40 rupees of losses helped me adjust capital gains from other, capital assets that I have. Right now, one is, this helps me push taxes to future, because this 40, when it comes back, I will of course have to pay tax on it. But the tax arbitrage here is also very good, right? For example, if I'm selling real estate, I have long-term capital gains which are taxable at 20%. But this equity loss that I had, so this 40 rupee loss helped me save 20%. So therefore my tax saving was 8%. But of course, when this 40 rupees is again recovered in the future, my taxation will be at 10%. So therefore the net benefit that I derived out of this activity was 4 rupees or 10% in our case. Right? That is one prime example that comes to my mind. Second, other examples, right? Because this is still market dependent. As investors, we do, may come across certain unfortunate investments. Examples could be, let's say I invested in a company and that company has now been delisted, it's not being traded, right? One of our clients did, in fact, I only got a document today of a particular company which was delisted and it's now in the process of liquidation. Our client had invested 1 crore in that company. Now, what we are working on is that I would want to capitalize on these losses, because it's anyway just, in my Demat account, the shares are being held. They're not providing me any value benefit to it. So what we thought is, let's maximize the tax benefit out of this. So this 1 crore, worth of shares that the client had purchased, let's say the current value is 5 lakh rupees only. So when I transfer it, my loss will be of 95 lakhs. Plus, I can also avail of the benefit of indexation. The client had made an investment in 2010. So the index cost could be around 1.3 or 1.4 crores, which when I sell it for 5 lakhs, it helps me book a loss of 1.35 crores. And this 1.35 crores of loss can help me save 20% taxation. So therefore, the tax benefit from this activity could be as high as 27 lakhs also, right? These are some examples that I wanted to share. The other point is that, let's say I'm not able to have any income in the same financial year, then no problem. Income tax says that you can carry forward these losses for the next 8 financial years. once you carry forward the loss, it can be adjusted against, the same head of income in the next financial year. So in the same year, for example, if I have a business loss, I can adjust it against, house property income. But once I carry forward this, then it can only be adjusted against business income in future. Then it can't be adjusted against house property. So the timing is also very, very crucial, right? So I just read out this particular para on the right side that I've written. Any loss that is not adjusted in the same year can be carried forward for the next 8 years. However, once carried forward, it can only be adjusted against the same head of income only, right? Kedar, I was able to share 2 examples. Do you think these are making sense to you also?
Yes, of course. So I think for just the understanding of general everyone, the point here is that, see, equity markets will keep offering you volatility, and that's the character of the investment. So you really can't change much about it. Markets will remain volatile. But what has happened and what we've discovered as a team, that since demonetization, the markets have kept on giving us many such opportunities where there have been severe market corrections, and that too all of a sudden, due to various reasons, due to various news and events which we came through. And these were opportunities where we could actually garner losses. These losses were artificially harvested on the portfolio. And hence, through this medium, we were able to basically knock off certain other incomes in the same year or the next financial years. So ideally, the point here is that we are able to try and see to it that the tax outgo is reduced in a legitimate way. So the post-tax income on the overall portfolio improves by a large segment. Chintak, I think you can quickly also highlight about one of the derivative losses which one of our clients had during that March 2020 period, and how that was possibly helpful.
I recall your client Kedar.
Yeah.
So just to highlight for the group, Kedar had a client who had incurred a good amount of derivative loss. I think it was almost to the tune of 1 odd crore. Right now, the client was a salaried individual, right? And after making this derivative loss, he decided I won't be doing derivatives in future. So therefore, if I didn't do anything, then I would have carried forward this derivative loss to the next year because he can't adjust it against salary, right? So therefore, the loss would have been carried forward, and in future, it could have only been adjusted against business income. Now, in this case, derivative was the only source of business income that the client could have had, right? Now, given that the client decided I'm not going to do derivatives in future, the loss carry forward would have been, sort of pointless or not fruitful for him. So then what we decided to book certain of his, capital gains. Now, there's a product that we do, which is market-linked debenture, which otherwise attracts a 20% tax. So we preponed the sale such that the derivative loss and the capital gains came in the same financial year. And therefore, the client was able to adjust it. Right? This resulted a tax saving of 1 crore into 20%, which was about 20 lakh rupees for this particular client. Right? I hope, Kedar, the numbers were more or less correct.
Yeah. We are online. Yeah.
Perfect. So that is the applicability of this. Just to, highlight it of the use of, how can we do this, even more to other assets. So unfortunate investments that, we've realized that our clients have made is also coming from, private equity funds, right, which have not delivered great returns. There could be shares, like I mentioned, which are delisted or not being traded, or the company is, defunct. That is another source. Third, which, a person, let's say you've given a loan to someone officially, and that loan, the person is defaulted on that loan. Even losses can be claimed on such investments. Right. So what we try and do is, once we have a meeting with our client, we try to get all of these details from our client, because the moment I explain this, then even the client, starts thinking, do I have something in our portfolio? So this is how we go about it. And, as per the details shared by client, we can then, further, probe into the transaction and see if any tax harvesting can be done or not. Right. With that, I think this was one key thing that we think our clients should know. And, we had highlighted it, but yeah, this is equally important for any other investor also. Right. Moving on, the second important point is tax implication on gifts. Right. As per Income Tax Act, gifts received in excess of 50,000 rupees is fully taxable. However, income tax says that, if I'm receiving a gift from a relative, then it is completely tax-free. Right. Now, relative is something that the income tax has defined, doesn't only mean blood relative, but they have a fine, I would say, a broader list of relatives. Relative include spouse, brother or sister of the individual, brother or sister of the spouse of the individual, all lineal ascendants, descendants, all lineal ascendants or descendants of the spouse, brother or sister of either of the parents of the individual, and spouses of all people mentioned above. Right now, this again is maybe too much English here, but for simplicity, I can say, for example, husband, wife, brother, sister, brother-in-law, sister-in-law. When I say lineal ascendant, descendant, we're talking about father, grandfather, great-grandfather, similarly children, grandchildren, great-grandchildren, right? Then all lineal descendants or ascendants of the spouse, brother or sister of either of the parents of the individual. So here we're talking about mama, chacha, right? And their spouses. So this is the exhaustive list. Now, again, this section has a very, very large application. The section in itself is very, very simple, but it has a very, very large application. But before I move on to the application part of it, one thing that I want to first also highlight is that what happens in case you transfer an asset. Let's say I have 1,000 Infosys shares. Now I decide to give that to my, let's say, my children, right? And then when they decide to subsequently sell it, from an income tax point of view, their holding period starts from the day I purchased it, and their cost is actually the cost incurred by me. So income tax assumes that, had that individual originally purchased it, capital gain should be calculated accordingly, right? So just to give you a small example, let's say I bought Infosys 3 years back. I gifted it to my son today, and he sells it tomorrow. Now, technically, he's only held it for 1 year. Oh, sorry, 1 day, right? But to calculate whether this was long-term or short-term, the holding period, which is, the period of time when I held it, also needs to be calculated. So even if he were to sell it the next day, it becomes long-term for him. Now, one application of this, which comes to mind, is from a surcharge management. As you could recall, is that the surcharge has, gone up drastically in the last couple of years, right? What are the surcharge rates? I also have a slide, but let me just address that. Or actually, I'll just go to that slide. Yeah.
Yeah,
these are the surcharge
rates. Maybe you can explain to our people here, saying that, how this applicability is more relevant to individuals like who are attending this webinar.
Absolutely. So that is what I'm coming to. So let's say I'm an individual and I am, in the 1 to 2 crore bracket, right? That means on the income tax, my surcharge is 15% because that's the slab for surcharge, which means that any income which is taxable at 30%, along with surcharge, that becomes 35.88, or any income which is taxable at 20% becomes 23.92. Now, how do I utilize this? I can, transfer the asset which is going to give me that income to my parents who may be in a 0 to 50 lakh bracket, or to my major children who may who again may be in a lower income range, and therefore from 23.92 I can bring down my taxes to 20.8. Now again, a simple use of section, but not everyone follows it, and that's why I wanted to highlight this. Okay, now does it make sense in context?
Yeah, of course, absolutely. Yeah. So every money saved is what we are trying to see to it that the next generation gets it higher.
And this is what actually bringing efficiency is all about, right? Trying to pay the least amount of taxes, in the legitimate way. We are not discussing about anything illegal here at all. But one thing that I want to first also give as a caveat, which is clubbing of income, right? If I were to gift assets to 3 types of people, then the income is not going to be considered theirs, it's going to still be considered as mine. And these 3 types of people are spouse, minor children, and daughter-in-law. For example, many a times, this is, I think, the most common example where a husband, let's say, is the higher income earning member, and wife, in case she's a homemaker, she may be in a lower income bracket. So the husband says that, let me give this 1 crore to my wife and she can make an FD out of it and she can pay the lower taxes, right? But in reality, as per section 64, any gifts made by, one spouse to the other and any income generated on that gift continues to be taxed in the person who made the gift. So in this case, if, husband were to give 1 crore to his wife and wife were to earn an interest on that, that interest is ideally to be taxed in the husband's name only. Now, earlier people did not used to follow this, but if you notice from this year onwards, there is this AIS or, annual information statement, which is available on the income tax website. So there is the income tax is getting more and more transparent. and therefore it is best to be on the right side of the law when it comes to all of this. So mixing section 56, which is the previous one that we saw, keeping in mind section 64, I can try to bring down my surcharge as per this particular table. That is what the three slides are. That is how the three slides are connected. Right? We have our clients who are in the 5 crore plus income bracket or in the 2 crore to 5 crore bracket, and they end up paying a higher surcharge. And these are the ways through which a surcharge can be minimized. Right? Kedar, anything that you wish to add to this?
No, I just was also thinking maybe if this section will be applicable for NRI clients. So possibly that also could be an area which is really useful for all.
Absolutely. I think very, very important point that you've just highlighted. Now, many of our NRI clients, right? I think majority of our clients have their next generation who are settled abroad, right? More often than not, it's typically US. Now, what is happening is that the child is, in US and is, having a job, is earning a decent income. Now, naturally, that savings that he's making, he wants to invest it, and he considers India as an investment, country for him. Now, what happens is he has two options. Option number one is he directly makes the investment in his own name. Then what's going to happen is that because the investments are in India, India as a country has a right to tax it, which we don't have a problem with. But because that person is a US resident, even US has a right to tax that particular income. And US taxation rates are far higher than Indian capital gains tax. So therefore, eventually what happens is that the child who is in US ends up paying higher of 2. So like an equity mutual fund, which is taxed at 10% in India, in US it could be taxed as high as 37% also. So what we have recommended is that let's use section 56, right? You accumulate a corpus, you gift it to your parents in India, let the parents invest their money. Let the parent invest the child's money in their name, because the parents have no linkage with US. So therefore US taxation is out of the picture, and that's how you can then minimize your taxes. Right? I hope, Kedar, that I think this example is very, very useful for many of our clients. I hope this is useful for all the Rotarians again who have children residing in countries where there is high taxation.
Correct. Correct. So there is a quick question on this from Mr. Deepak Chaudhary, that as far as he knows, India has double taxation treaty with the US. So tax has to be paid only in one country.
So I would like to clarify here that yes, India does have a tax treaty with US. But when I look at the capital gains article of the India-US tax treaty, the capital gains article says that both the countries have the right to levy taxes in accordance with their domestic law. And the methodology that this India-US tax treaty has adopted is giving a tax credit. So what happens is when I'm supposed to pay 37% in US will say that, whatever taxes you've paid in India, you can take that as a deduction and only pay the differential. So in this case, 37 is my US tax liability, 10 is something that I've already paid in India. So US says you just need to deposit the next 20 or the balance 27. So eventually, from an investor point of view, he has paid higher of 2, which is 37. Right? I hope that clarifies for Mr. Deepak.
Yeah, I think that's so. There is an arbitrage. There is clearly an arbitrage which can be benefited out of it if we were to really transfer this as a gift or specifically for NRI kids or grandchildren who are settled outside.
Perfect. Thank you, Kedar. Yeah. And also, just on the surcharge, many of us also have an HUF, right? And HUF is also getting a slab rate benefit, and it's also get fresh rates from a surcharge point of view. What I want to also add is there is a concept of a private family trust also, which is an entity very, very similar to HUF, but without the disadvantages that an HUF has, right? So it is an HUF-like structure, but without the disadvantages. That entity can also be considered to minimize surcharge. So Sanobar will be discussing the private family trust concept in much more detail in her presentation, right? So I just want to leave it at that. And the last point, which is there is a risk of India reintroducing estate duty. Now personally, I have been in Anand Rathi for past 7 years, covering the budget every year. And every year when I go through the newspapers, a couple of days prior to the budget, I believe there was a recent article also which speaks about estate duty, right? Now, our concern is that as HNIs, if estate duty is to be introduced in India, there is a good likelihood that we will be prone to estate duty. Now, there are 2-3 questions lingering around, the concept of estate duty. One, is there a need for the government to, have estate duty? The answer is yes, at least we feel so. Because if you, recall the recent changes or the recent amendments that have been introduced in the budget, all of those are targeting any tax benefit that was derived by HNIs. Insurance getting taxable, the surcharge rates going up, etc., etc. Right? So, yeah, the government certainly wants to target HNIs from a tax point of view. Second is, India had wealth tax in the past. Till 2015, we had wealth tax. If you recollect, we had to pay 1% tax on wealth exceeding 30 lakh rupees. Right? Now, the reason wealth tax was abolished, the reason quoted was that the administrative costs were very high. So the next alternative is I can introduce a one-time tax rather than collecting taxes annually in the form of wealth tax. I can introduce a one-time tax at a much higher rate, right? And that is what is called estate duty. India is the 6th largest economy after US, China, Japan, Germany, and UK. And 4 out of these 5 economies already have estate duty. So yes, if we are moving towards a developed economy, then estate duty is also something that India may consider, right? And therefore our wealth is at risk. Just to give you, the context of what is the wealth tax applicable in various countries. So we have US taxing at 40%, Japan at 55%, Germany 30%, UK 40%, France 45%, South Korea 50%, and Spain 34%. The point that I'm trying to highlight is that estate duty is not going to be a minute percentage of 1% or 2%. It is definitely going to be upwards of 30 to 40%. So the point in question is that 30 to 40% of our wealth is at risk when it comes to estate duty. I have mentioned the threshold limits, but these countries may not, or depict the true picture of India. India, we are expecting that the limit may be 10 crores to 20 crores or something like that. So the point is, any wealth that we have is prone to, or is sort of potentially liable to estate duty. And what we've realized is that a private family trust, if I were to create, may help me minimize estate duty. The logic being quite simple. See, today I don't have estate duty in India. So today, if I were to gift 1 crore, let's say, to the next generation, that is not going to attract any taxes, right? So similarly, if I were to create a trust today and transfer the assets there, then what has happened is I've already made the gift. Now, if 1 year later or 2 years later, if India were to introduce estate duty, is there a likelihood that they will go back and say, whatever gifts you made in the past 2 or 3 years, we are going to tax that? That seems very, very unlikely. So therefore, we've been, we are recommending our clients to create a private family trust, and also consider as a objective to minimize their estate duty. Right? I won't go into the details of private family trust because that is something that Sanobo plans to cover. So this is and we've just done a very, very sample calculation of what is the benefit. That the potential answer here is that a person could be richer by 35% if estate duty were to be introduced under certain assumptions. So that is the kind of large impact that it may have over a person's net worth, right? So Kedar, I think that was all from my end. Due to again paucity of time, I've not dwelled into deep conversations, but I've just scratched the surface. We can certainly have more discussions on an individual basis if anyone is interested. I just want to clarify that for the group. But we've scratched the surface. Yeah.
Thanks, Chintak. So this makes sense. So quickly moving to the lines of the subjects, like how Chintak just mentioned on the last part, which is a very important area for inheritance tax. And I think which getting applicable will be also a case for everyone on this group to possibly look at and plan about. So to continue of how possibly that can be managed, the inheritance tax part, I think Sanobar can share her inputs on how a private trust can really help solve this case.
Yeah, sure, Kedar. Good evening, everyone. So I'll just put the presentation on the screen. It's visible, right?
Yes, it is.
Yeah. So just moving ahead from what Chintak discussed about private family trust. So private family trust is not only just to create an entity from an estate planning, estate duty point of view, but it also protects your wealth against certain other things, which I'll take you through. Now, before I move ahead, let me just briefly tell you that as the name suggests, it's meant for family members. We've always heard trust as a charitable kind of a thing, but private family trust is more to do with the family members and the assets that pass on to them through the trust, right? So it is, if I have to just define it in one word, it is just a bank account that a person creates, and the assets are passed on through the trust. Now, when we create this trust, it's created for certain objectives. The first objective being to ring fence your wealth. Ring fencing basically means to safeguard your wealth against any risk that a person may have in his own business, or if a person is a professional or a director, independent director, any profession where there are certain kind of risk involved in what you're doing. And if that decision or the signing authority that you may have, if that goes back on you and some liability were to come on you, then all your personal assets could get attached. So in that scenario, what happens is all your financial as well as assets that you have in your name could get attached to pay up the liability. So what a trust does is that you create this entity when there is no such liability or anything that you are facing, and a portion of your wealth gets parked in the trust. Now, trust is a separate entity. It has a separate PAN, so it's treated as a legal. It has a legal status. So whatever money goes in the trust is meant for your family members, and in case of any liability coming on later on, the money that has already moved to the trust is not attached by any authority, because the money has already moved from your name to the trust name. So it no longer belongs to you. It is not a part of your balance sheet, right? And as I've given examples that if people are in business or they are directors, so it's not only applicable to such kind of people, but risk and liability can be something that can be applicable to people who are having properties which they give it on rent, thinking that there will be no such liability on them. But if any mishap happens on that property, the owner, of course, along with the tenant, is held liable. So we have seen enough cases where such a thing has happened. Plus, many a times people are chairman or secretary of a society, of a cooperative society, and if certain norms are not followed, then there could be some liability on them as well, right? So these things are like an eye opener to see that if you are in any of these positions, will a private trust help in safeguarding your wealth against such risk and liabilities? So that is one thing, first objective of creating a private trust. Second objective is more from an estate planning point. Though estate planning, succession planning always means that we have this thing that will is there to take care of that aspect. But will is something, of course, it is equally important, but will is something that comes into life when the person is not there. As well as, so a trust is created in your lifetime, and you are seeing how the assets are moving on in the trust and how the succession of that is happening. So just to give few examples of that, one is where people have more than one child. And if they feel that later on after them, there could be a potential dispute between both the children, or even if there is no dispute, they just want to have a clear segregation of assets, then they can plan to have two separate trusts for each child, saying that this trust is meant for child one, this is for the other child. So that way you can have the succession planning done, right? So both the trust will be independent, even if there is a dispute between both the children. Second example or second thing from an estate planning point is where there are minor children. Now, if a person makes a will where all the assets after the parents are moved to the minor child, then and if something were to happen to the parents when the child is a minor, or say 18 or 20 years of age, that age is not a matured age for the child to inherit that kind of wealth. So in such a situation, what people are doing these days are creating a private trust where the trust continues to be in existence till the child attains a matured age. So when they are in the 30s or 40s, and if the money moves to them through the trust at that point in time, then they are of a matured age to handle the kind of money, rather than giving them through the will. Because what happens is, if in a situation where parents are not there, entire money from the will can pass on to the children, though there will be guardians and people to take care of the child, but ultimately at 18, they are independent to take decisions. So having a trust for this particular objective definitely helps when there are minor children. Third option from a succession planning point is, when kids are there, they are married. Now, if God forbid something were to go wrong in their marriage for one of the child, and if the assets from the will have passed on to the child, then what happens is that it becomes their own wealth and would be subject to claim by her or his spouse. Now, if that same situation arises when there is already a trust where your child is a beneficiary, then what happens is that the spouse of your child will not be able to claim those assets. Reason being that one is that the assets are already in the trust, so they are not belonging to your child. Second is that the spouse of your child is not a beneficiary. So therefore, nobody can claim those assets. The spouse cannot claim those assets because it's held by the trust and your child is just a beneficiary of it, right? So these things help as far as succession planning is concerned, right? So trust does help from that point. So that could be the objective number 2. Third objective is what Chintak has already discussed, which I'll not go in detail again, because it's mitigating the risk of estate duty. So how it helps is that a person creates a trust today when there is no such estate duty currently. So what you do is a portion of your wealth goes in the trust, which means the trust is the owner of those assets and the money in the trust keeps growing. So supposing, say, just to give an example as far as numbers are concerned, if a person has 10 crores, he transfers 4 crores in the trust. Then that 4 crores over the years may become 40 or 100 crores. That entire 100 crores will go to your child or children without any payment of estate duty. Because generally what we have seen is estate duty is on the individual's wealth and not on the trust. Trust is a separate entity. So whatever you leave behind in your personal name could be subject to estate duty if it gets reintroduced in India. But whatever is there in the trust may not be applicable. So that is what objective number 3 does as far as private trust is concerned. Last objective is more relevant for NRIs. Supposing, say, clients have kids who are NRIs. Now, if they are earning, they are NRIs and they are earning over there. Now, their objective of sending money to India is to earn better returns. Okay, so the option that they have, if they want to, invest in India, is either they invest in their name, invest through the parents, or through a trust set up by the parents. The first is if they invest through their name, the challenge is one is that they being NRIs, they don't have options, or India does not allow NRIs to invest in all financial products. So therefore, the main reason of sending money to earn better returns is not met because they can't avail all the options. Second point, what Chintak had also mentioned about the taxation, that if they invest in India, they pay taxes over here. And depending on certain countries, they have to pay taxes on the differential in the country where they reside. So that could be an issue if they invest in their name. Then next is that if they invest in, say, the parents' name, that also can be done because parents are resident Indians and they can invest in all financial products and the objective can be met. But if they invest in parents, the risk is that it will be only till the parents' lifetime. So after that, they again have to find a solution for that. And many a times people are not, they don't want to do the investment in the parents' name. Reason being that if they have siblings, then what happens is that the assets have to be gifted to the parents and parents invest in their name. So in case if they don't have a proper succession planning or a will in place, then the assets can become accessible to the other sibling as well. So that may not be a comforting thing for them, right? So the last option and the best option for NRIs would be to have a private trust set up in India, because private trust is a separate entity. It's created in India, managed in India. So therefore, it can invest in all financial products. And therefore, the objective of earning better returns will be met through this trust, right? So these are some 4 objectives, broad objectives. Could be relevant, all could be relevant to a person or some of them. So that is one thing. Moving ahead with the structure of the trust.
Sorry, Sanaba, one point.
Yeah,
If we can go back to the previous slide. Yeah, so I think the question that was asked to me by one of to a person who we had presented this was that when should I create a trust, when maybe at least a couple of objectives are relevant for me, or if any of one objective is also relevant for me. So I had just answered that if any of these objectives is something that is relevant for you. So if my objective is purely estate duty, or if it's purely ring fencing, then we can still consider creating a private family trust. Of course, after understanding, the finer nuances of the trust. Sorry, that's what I just made.
Perfect, Chintak. So yes, so moving ahead on understanding, if supposing a person, as he said, if only one objective is relevant or all are relevant, what is the kind of structure or who are the parties to the trust? How is it created? So one is that there is a settler who's the creator of the trust. Settler is the one who contributes money to the trust. Money comes in the trust account, which is, as I said, as simple as a bank account. This money is used for the beneficiaries, who are the family members of the settler. Since it's a private trust, the relation between the beneficiary and the settler should be of a relative as defined under income tax, which Chintak had showed in his relative slide. So there is a settler, the money goes to the beneficiaries, it is used only for the beneficiaries. And to manage the trust, there are two trustees who are required. Now, as far as achieving the objectives which we discussed, if a settler creates a trust and funds money to the trust, that money has to move out of his balance sheet, which means he has to transfer this money to an irrevocable trust and lose ownership of that money once he transfers it to the trust. So what happens is that since it is his hard-earned money, what we do is we generally, as a practice, make the settler as the managing trustee. So by being the managing trustee, the settler has full control of the assets, in the sense to to decide where the money goes, how much of it is used for the beneficiaries, where it is invested. So all the decision making that are done by the managing trustee of the trust. So he is the signatory authority in the trust. Now, second trustee, as you can see, could be any confidant, say a family member or a non-family member. Reason for having the second trustee is that the private family trusts are governed by an act known as Indian Trust Act 1882. Now, as per that act, they are saying that you need to have minimum 2 trustees. Okay, so that's why the second trustee is there. But when we set up this trust, a trust deed is prepared. Trust deed is like a rule book where you define all the terms and conditions. Now, in that, it is clearly mentioned that who has the powers, whether the second trustee has the powers or the managing trustee. So we clearly define that the managing trustee will have all the powers. Second trustee is like a dummy person, only required to sign certain, when we set up the trust, they are required to sign certain documents. Apart from that, no decision making is to be done by the managing trustee. And the other important point is that if we set up a trust, the type of trust that is to be created in order to achieve the objectives which we discussed is an irrevocable discretionary trust. Now, irrevocable would mean that settler contributing any money to the trust, he cannot take it back in his own name. He has given it away irrevocably. It is only meant for the beneficiaries, and that's the way he gets protection under the objective number 1, which is ring fencing and estate duty and other objectives. So as a settler, he cannot take it back. And that's the reason why we, generally say that don't put 100% of your wealth. What you think you need to consume in your lifetime, you keep that aside. What you think you're anyways going to pass on, you put that in the trust, right? So that can be used and transferred to the beneficiaries.
Yeah, I'd like to add one point, Sanabha.
Yeah,
Sorry,
please.
so I've just got a message. I think we'll have to move fast. We just have 5-7 minutes left.
Okay, fine.
Yeah.
I'll just mention my quick points, Sanabha.
Yeah.
The main difference between gifting versus transferring asset to a trust. In both the cases, I'm losing ownership, right? The asset does not belong to me anymore. But the benefit in a trust is that I still get to retain control over it because I am the trustee, right? So from an inheritance tax point of view, I have an option of either gifting the money or transferring assets to a trust. The second option at least helps me still retain the controlling power. Right? That is, I think, one important point that everyone should just know.
Yes, and just to complete this slide quickly, Discretionary, on the other hand, means that the entire decision making is with the managing trustee, and he will decide or she will decide how much money will pass on to the beneficiaries at what point in time and when and how much, right? So that is what is the type of trust. So that's basically for the private family trust. Moving ahead with the will part. Now,
I think just to summarize for everybody, see, usually will is something, as people are aware of, how you can really plan your estate succession planning. Trust is a very lesser known subject, and trust is something where you will be able to see the asset transmission during your own lifetime. A will gets executed only after one's lifetime. So the good part with the private trust is that we are able to execute it while we are alive, and hence that becomes a really interesting area for clients to really plan and how do they want to distribute their wealth. Yeah, Sanovar.
okay, yes. So the next important aspect is to about the will. Now, why a will is necessary is that what we have seen is, of course, in a person's lifetime, that person is not going to consume all the wealth. So that wealth has to pass on to the next generation. And we ensure that by making a will and doing things around it, ensure that the transmission happens in a smooth manner. So before we get into how you should go about making a will and things around it, let's understand what are the ways of distributing wealth. One is that if a person chooses not to make a will or does not have a will, then his assets or her assets pass on as per the personal law of the religion each person belongs to. Second is, if you have a will, then you can definitely decide and mention your desires in the will and say how you want to pass on your wealth. Third important point is also to ensure that each asset class has a joint holding and nomination pattern required. So we also ensure that this exercise is also done so that the transmission happens in a smooth manner, right? So taking each one of those, let's understand if there is no will. If a person chooses not to make a will, then what happens to his or her assets? So every religion that a person belongs to has a succession law attached to it. So for a Hindu Succession Act applies. For a Parsi and Christians, Indian Succession Act applies. And for Muslims, there is a Sharia law. So each of these laws have a predefined succession rules that if a person is no more, then his or her assets pass on as per the predefined succession laws.
So this was pretty interesting. Whenever we used to interact with a lot of our clients, more than 70-80% of these people with a net worth of more than 15-20 crores didn't have a proper estate planned out. They have not made their wills. And when we brought up a discussion around saying that based on their religion, the wealth will get transferred, it was a big eye opener for everyone, because just to quickly highlight on the Hindu Succession Act and not to talk about the rest of the two, the wealth distribution might happen in a manner which you might really not be wanting to distribute your wealth as per that. So Sanovar, quickly just cover Hindu succession law.
Sure.
So if a person who is a Hindu dies in testate without a will, what happens next?
Yeah. So Hindu Succession Act says two things: that if a male member is no more and there is no will that he has left behind, then his assets pass on equally to his mother, wife, and all children. So if he has 2-3 children, so all 4-5 people will get all his assets equally. So that means that if he desired or if he thought in his mind that he would want everything to first go to his wife and then to children or to the other people, then that will not be met if there is no will. Similarly, if a female Hindu is not there, then her assets get transferred to the husband and the children, passed on to the husband and the children, all equally. So again, that may not be the desire. Then you need to have a will in place. So I'm not getting into the other parts, but just moving on, that if there is no will, we saw what happens. So it is better to have a will. And when you have a will, what are the things that you need to keep in mind for drafting a will and having the succession planning in place? So one is, when you decide to make a will, what first thing you need to do is to define clearly what is your desire of distribution. Whether you want to give it everything to the spouse first and then to children, or a combination of that, or do you want to give some amount to charity, some amount to some domestic help, to anybody, any other family members. So you need to define that. Secondly, the will should be simple and clear, should not have too many asset details. So basically, all the movable assets that a person has the potential of getting changed over the period. So frequently these investments and all can keep changing. So we don't mention that in the will. We just mention the real estate address in the will, so that is clearly captured, that what all properties you had, right? So apart from mentioning the asset details are more required for the family members to know where all assets the parent had, for example. So that is captured outside the will in a separate document. For the will, it's to keep it simple. Now, when we are dealing with young couples who have minor children, mentioning a guardian is very important, because if you don't have a guardian mentioned in the will, then whoever takes the custody of the child has to go through a legal process of getting an order from the court and getting a legal guardianship before they take up this role. So that is important. Fourth important thing is to appoint an executor. Now, executor is basically a person who will do the transmission work of getting the assets transferred from, say, the husband to the wife or the children, like that. So mentioning an executor is important. We generally prefer the family members. Like if a husband is making a will, wife can be the executor. And if wife is also not there, the kids become the executor, rather than having a third person as the executor who has nothing to do with the will, right? So that is another thing. Fifth important thing is that registration of a will is not mandatory at all, but we highly recommend people to register it, because it adds authenticity to the document. So if anybody challenging your will that you were of unsound mind or it's a forged will, your family members will have a registered will to prove that it's a genuine will, because there is a government stamp on it, and the registrars keep a scanned copy of that document for their records. So that can also be produced to show that it's not a forged will, or it's a genuine will, basically, right? So these are important things for considering or having a proper will in place. And along with that, what is also important to ensure that each asset class that you have has a facility for a joint holder and a nomination. And it is better that once you make a will, you do that exercise as well, of ensuring that each asset class has a joint holding and nominee as well. So for example, if a client is if a person is husband is making a will saying all assets go to wife and then to children, ideally joint holding should be with husband and wife, and the kids should be the nominees, so that what you're saying in the asset class, the same thing your will is saying, and there is no dispute or discrepancy in either of them. Because in India, the nomination laws have a different holding for each asset class, which I don't want to go in detail, but it is better to have it in sync so that there is no dispute in future, right? So these are the things that are required for a will. Yeah, Kedar, I'm done.
Yeah,
anything you all want to add?
No, I think on the private trust part, the most important thing that maybe for this group's benefit should be known is something that medical negligence is a big area which is largely coming up, and the ring fencing part would be very beneficial to all the doctors when they consider these kind of uninvited or maybe negligencies which can come and attach their personal wealth. So, of course, this is a very large subject, and we are trying to kind of reduce it only to a few slides. So even in case of wills and all, there are so I've got questions in person and also on the open chat, that why would a CA not be able to do this? So the answer is that, of course, everybody, there is a specialist for each of these roles. So when you go to a general physician, there is a separate function that you're going to, he's going to address to. So chartered accountants, of course, they have a lot of capabilities, and due to their experience, they've been doing this regularly. But a wealth manager who is actually in synchronization with your day-to-day assets and your day-to-day wealth distribution, they are possibly having an edge over a guy who's just maybe filing your taxes. So, so there are, different answers to this. There is a question which says that what could be the amount that can be parked into the trust? So see, generally what happens is that this is an amount which has to be decided based on your lifestyle expenditures today. And we need to really sit down, calculate the cash flows, and really understand inflation adjusted what will be your financial requirement 10 years from now, 15 years from now, 5 years later. Based on that, we can give you guidance saying that what is the corpus that you can start with by parking it in a trust. So for each one, that is it's going to be different. Uh, there is a question which says, even if one has a will after his expiry to transfer a property, do we need a probate? I think Sanovar can quickly answer on this, because there
Yes.
are a lot of questions that we always get in terms of transfer of properties.
Correct. So, so as per law, any property held in the city of Mumbai, Chennai, and Kolkata, a probate of a will is a must. And even, you know, if you go to other cities like, say, for example, Delhi, Pune, currently these days the property disputes are increasing, and therefore the registrars, whenever you go for any transfer of property, even if there is a registered will, they will insist on you getting a probate. So yes, that is required.
Sanovar, there is a quick question. If the will is prepared and signed by a notary, registration is necessary or not?
So either you sign, I mean, so if there are 2-3 ways. One is you just sign it with 2 witnesses and that makes the will valid. Or second is that you sign the will with 2 witnesses and do a notary on that. So then after the notary, you don't have to register that same will. Okay, either you do a registration or you do a notary.
Right.
I think let me address that in 2 parts. So registration is something that is not mandatory, but we certainly, prefer the registration part of it, right? We want registered wills to be there. Chances of dispute, go down drastically. Point number 2, if you're notarizing the will, or you're doing it in front of a notary, then registration is not required, right? But Sanovar, do we have a preference between doing it in front of a notary or at the registration office? Is there any difference amongst the two?
Yes, of course there is a difference. Though a notary is somebody like, though there's a government stamp, their notaries are also government people. So that is also good enough. But registration, what happens is that notary does not keep a scanned copy of the record of the will, whereas a registration office does that. So it is much more beneficial, because if tomorrow a notarized will is to be produced and said that it's a forged will, or you were not present in front of the notary, then the notary does not have any proof to validate that, whereas a registrar will have that.
Got it. So registration is the best.
Yes.
There is one last thing which says that for individual, it is very difficult to look into all this. And hence, as a part of the wealth management, we are only not generally discussing of what possibly investment opportunities are, but Anand Rathi Wealth team and maybe a lot few other people as advisors have also started highlighting the aspect of how do you really look into transmission and estate planning. So this is an area which is, I think, a very hardcore objective for wealth management these days. And as a firm, we've taken a decision that we will not separately charge our clients, whoever is dealing with Anand Rathi, on these subjects, because we are encouraging the clients to really spend some time on planning their future and the succession plans in the family. So yeah, I mean, of course, it's not an individual's case. There are advisors which will be required to handle these matters to answer the question.
And one last point to further add to this, this is not as complicated as one imagines this to be. This process is rather simpler. I think with focused attention, one can have the will or the trust discussion, probably within a month's time, everything can be ready, right? So that's the kind of timelines also that are that one can take, right? So it's not complicated, but yeah, it does need your attention, to get the process started.
So I think, want to close this conversation with just one line, saying that we spent a lot of amount of time growing our wealth, but what would happen, I mean, when we need it the most and it's not available? So it's like you are actually going through a cardiac arrest and your doctor does not answer your phone. So it's something similar like that. You spent your entire lifetime creating your wealth and generating these assets. But what if it's not available for you at the right time, or maybe to the next generation, it's not available at the right time? So that's where we are spending a lot of time handling this. I think, yeah, that's all from us. If there are any more questions, maybe Deepal, you can close that.
Yes. Thank you, Kedar. Thank you, Chintak, Sanovar. So on behalf of Anand Rathi Wealth, I, Deepal Patel, am extending my heartfelt thanks to Rotary Club of Bombay Northwest President Mr. Jatin Patel, Secretary Mr. Mihir Vora, Club member Mr. Sandeep Porecha, and Mr. Manish Desai for providing this wonderful Rehan has shared his email ID and mobile number on the screen. You may please note it down, and you can text him, call him, or shoot an email, and we will reach out to you in reasonable frame of time.
Yeah, we are not, sorry, Rehan, we are not able to see the.
Don't worry,
Now we
Chintak
can.
and Deepal, we will definitely circulate your contact details on our group. Thank you, Deepal Patel. It's been an excellent, talk by Chintak and Sanovar, and very well moderated by Kedar. The topic was very good, and I'm very glad that this has been recorded. It went out of my mind, but it has been recorded, and it will be very useful. I will definitely revisit this conversation once again at when I have a good free time, so that I can do my personal wealth planning for my children. I have two daughters, so I never took whatever I have seriously in terms of finance. So now I will have a good look. You have given us so many, insight on opportunities of how to build your wealth from what we have created till now, and grow it for your future generation. It's a good insight, and also very particularly interesting. I liked what the private family trust also. I think it's a very good concept, and I think I'll be getting in touch with Kedar to learn more about it. Thank you.
Thank you, Jatin
Thanks,
bhai.
Kedar, for this excellent, presentation. And it's a 1 hour presentation, and I think we have 45 people glued to the screen throughout, and we had good questions and good learnings. Thanks.
Thank you. Thank you. Anytime, Jatin bhai.
Thank you so much, everyone.
Thank you so much.
Thank you. Thank you.
Bye. Good night, everybody.
Good night. Good night. Thank you.
Thank you.
Thanks
Thank
a lot,
you.
everybody.
Thank you. Thanks.
you.
Bye-bye.
Bye.
And,
Good night.
and
Bye
thank
bye.
you all the Yellow Sapphire presidents and co-host clubs for being here, and district dignitaries for being here. Thank you.
Thank you. Good night.
Good night. Good night,
Right.
everyone.
Good night. Thank you.
Thank you.
And last but not the least, thanks to Hiten by Anandpara for arranging this meet. Thanks on Zoom and YouTube. Thanks.
Thank you, Sanovar. Thank you, Rehan. Thank you, Deepal. Thank you, Chintak. Thanks, everyone. Bye.
Thank you all. Kedar, thank you very much. And your team also. Thank you.
Our pleasure. Our pleasure, Kamlesh Shankar.
Thank you, everyone. Good day. It's good, informative info. Thank you.
And I say hi to my all Rotarian friends.
No, liquid तो गया,